The tax regime in India is one that allows taxpayers a lot of opportunity to save tax and reduce our income tax liability. Our next presentation becomes extremely relevant, especially as ITR filing dates inch closer. We have with us today Mr. Rahul Sevda from ClearTax. His expertise spans around income tax, corporate compliance, and business advisory. Rahul will take questions at the end of the sessions, which I will moderate. And with that, I'd like to hand it over to Rahul.
Hi, Kavita. Thank you for having me here. It is a pleasure being a part of this panelist. And welcome all. Today we'll be discussing on various aspects which is applicable for the individuals on direct taxation. And we'll be talking in depth about the capital gains, advanced taxes, what we have to pay quarterly, and then what this budget has for us, and what are the changes that has been introduced which will be beneficial to us. We can start with the second slide. So basically, we are going to discuss, and what you are going to take home from this is what all documents do we need to have with us while we are planning to file our income tax returns, why this document file is important, okay? And then what is a capital asset, what is a transfer, basically, like when you determine whether you are going to have a capital gain or a capital loss, and for what period you are going to determine that gains or loss, okay? Then we will be touching upon what is like a short-term or a long-term capital asset, tax saving opportunity if you have a capital gain, if any, and tax compliances and advanced taxes. After that, we'll be discussing mostly on budget. Let us move on to the last slide, the second slide, okay? So what all documents do we need to have in order to prepare ourselves to file the income tax returns? So basically, if you are having any type of income, so make sure that all the documentary proof are available to us. For example, if you are selling your house property, if you are dealing into shares, and you have the intraday transactions, or if you have any other speculative income, and then whatever statements or broker receipts you have, you should keep all that in your file. You can maintain an electronic file if you want, because that is more convenient nowadays. So but all the documents should be there in one file, because at the time of preparation of your ITR computation, that how much tax you are liable to pay. So this file will help you a lot, because you don't have to keep on running and searching for all the other document for this computation. Otherwise, when like say for example, if the assessing officer wants you to assess your income, and they will be asking you several documents, like all kind of document, including bank statement, including the income proof, whatever it is, then this file will be useful to you. Apart from this, the government also gives you some documents what you can refer to and what you should refer to. One is the annual information statement. The another is Form 26AS. I think the annual information statement will work both for itself and Form 26AS, because all the information are contained in it. Form 16, if you are a salaried employee, but since you are investors and you may be having the business income, or in certain cases, if you have salary income, then Form 16 along with all its annexures in order to take the computation, like how it works and what all exemption you are going to get. Apart from that, if you are investing in house property and you want to take the benefit of the interest paid for the home loan, or if you want to take the benefit of the principal component, then you need to have the home loan certificates. And of course, the home loan approval document, you can keep that in the file. So we were talking about what are capital assets. So whatever asset we are holding that may not be classified as a capital asset. Okay, so what exactly is a capital asset? So those assets which generally appreciate over the time, and which you put your money in, so that at a later point of time you can sell it off and gain some income. Okay, so generally by layman's term we understand this as a capital asset. So do I call a car, a luxury car, as a capital asset? No, that is not a capital asset. If I have a luxury bike, is it an asset as per income tax? It is not. Or any kind of clothing what we have, if you are buying for Gucci, Balenciaga, whatever it is, these are not assets. Because see, maybe for some person who is a celebrity, it may become an asset because they are going to sell it off in an auction and gain money. But not, generally speaking, this will not become a capital asset as per income tax. Okay, so only those assets which are going to get appreciated and you can gain some money out of it in future by selling it, becomes a capital asset. Now, when we say, okay, there are certain kind of assets which I would like to define. One is anything made out of precious metals, either it is jewelry, bullion, or any kind of artifacts, whatever it is, that one. Then whatever shares or securities we have, including mutual funds, debt securities, whatever it is, those are classified as capital assets. Mutual funds and these kind of shares, whatever it is. Apart from that, we have land, building, whatever immovable property we have, that is also classified as a capital asset. Moving on, so why do we need to understand whether it is a capital asset or not? So in the next slide, we'll see like how the transfer of a capital asset is affected to us while computing the income tax. So what does a transfer means? So am I, if I am holding this capital asset, giving it to my children, is that a transfer? Okay, is that a transfer? So basically, the transfer means that you are selling the property, or you are exchanging the property, or you are relinquishing your right in the property for any consideration or not. So here the consideration may not be important. You might give it away to someone for as a gift, but still that will be considered as a transfer. Extinguishing your right in any asset, or when the asset is matured, or you are redeeming that. So in case of shares, in case of you can say mutual funds, it gets matured, or you redeem that asset. So these all are deemed to be a transfer. Now, say for example, we are transferring our property to our children. We are not assigning the name. The title deed has not been yet transferred, but he is now the owner of the property. So will the transfer be considered here, and will you have to pay any income tax? Because obviously every year the price of the property will increase. The answer is no, because this is a ancestral property moving on to the next generation. Now, say for example, if your son tries to sell the property, so what he will consider is from the original holder of the property, like who has the title, maybe your grandfather or maybe his grandfather, then he will have to compute the holding period from the very first holder of that property, and then the capital gain will be computed. So it is not that every time in an ancestral property you have to consider it as a transfer. Moving on to the next slide. So as we discussed the about the holding period, like how do we determine whether the capital asset will be treated as a long-term or a short-term capital asset? Now, why does this matter a lot? Why do you have to compute exactly if it is a short-term or a long-term asset? Because obviously, as we are discussing on taxation, so the tax will change. Like once the property becomes a long-term property, the tax will reduce and you will get few more benefits on computation of the capital gains. So what is a holding period? So as I told in the case of an ancestral property, so who is the original holder of the title of the property? From there, you will compute at the time of sale or at the time of transfer of the title. You will compute what is the period of holding for that entire property. If it is a long term, if it is more than 36 months or 24 months in certain cases, this is determined to be a long-term property. Then what all benefits you get when the property becomes a long-term property? I'm talking in connection with every kind of capital asset, not only just a house property or something. So whenever a property becomes a long-term property, in case of unlisted shares or any other kind of capital asset, you are given a benefit of indexation. Like say, for example, we know 100 rupees back in 2010 is not the same as 100 rupees today. Okay, so there's an inflation added to it. The price of the value of the money has gone down, and the cost of all the things have gone up, and so many other factors. So you determine that, okay, my property was bought back in 2010, and now if we go back in time value of money, what is the today the price as of today, if I would have bought the same property today, and then how much I'm selling it for. So you are determining the cost as on today, and then you are determining how much you are selling it for. Then the difference becomes your capital gain. So this indexation benefit is only available in the long-term property and not in the short-term property. Okay, so basically, for most of the assets, the holding period should be more than 3 years or 36 months. Uh, to be called as a long-term property. Otherwise, it will be a short-term one. Okay, and for like listed shares, if you are investing in the market, if it is a listed share, then the holding period is only 12 months or less to become a short-term. Beyond that, it is a long-term property. So for shares and securities, if we talk about the rate of tax, then if the share or security, whatever it is, if it is a listed share or security and you are paying the securities transaction tax, then the tax rate will be only 15%. So it is a special tax rate. The tax rate is 15%. Beyond that, if you are selling the property, I mean your shares and security, and if it is a long-term property, then only 10% of tax you have to pay. Now we are say like if we talk about land and building or something like this, then the rate is if it is short term 30%, if it becomes long term 20% along with indexation benefit. Moving on in the next slide. So what is a holding period? I think this we are okay. This is in continuation with examples. So as we have already discussed about the rate of taxes, like say for example, whenever we are dealing in shares and securities which are listed on stock exchanges. So if you are holding it for a short term period, then the tax is 15%. Once it becomes long term, the tax is 10%. Where up to rupees 1 lakh, you are being exempted to pay any tax. Beyond that, whatever your income is, you have to pay the tax on the capital gain only. We have discussed in details what is indexation. So indexation basically is only when the property becomes a long-term property, then you are given a benefit to compute the cost of the property as of today. Okay, so as on the date of sale, so you just compute like what is the cost as of today, and then the difference is capital gain or loss on which you have to take the tax, or if you have to if you have a loss, then you can carry it forward to the future years. Moving on to the next slide. Okay, so now it is a very important topic where we can understand that how we can save capital gain tax. Like if we have any taxes on the capital gains what we have made, can we save any taxes on this or not? The answer is yes. Like let's start with few sections. So here we have mentioned section 54, 54F and 54EC. So what 54 section means? So basically, whenever we have a house property, okay, any residential house property mostly. So when we have a house property, we are selling it and buying another house property. Okay, so generally, if you see, a house property will never be a short term because everyone will be holding it at least for 3-4 years minimum. Okay, and if someone is only dealing in house property just to buy and sell, that is a different case. But generally, you see, a house property is a long term capital asset. Okay, so whenever you are selling the house property, buying another house property from that money, then whatever money you are investing in the new property, that is exempt from tax. Okay, so like say for example, if you sold your old flat and you are buying a new flat out of that, whatever amount of gain you have got, if you invest that in the new property, it will not be chargeable to tax. Okay, now section 54. What is section 54? Section 54 says that okay, you have to buy a new property, but you don't have any existing property to sell. Now, many people, what they do, they will sell their investments. They will sell their shares. They will sell their gold or bullion, whatever they have. So if you sell any long-term asset apart from house and property, and you invest in your new house, okay, in that case, whatever amount of sales, the sale proceed or the consideration you have received, if you're investing that in the new property, then entire amount of capital gain, if any, will be exempt. You don't have to pay any taxes. So this is good for those people who are going to buy or construct a new property. Okay, and if you are selling your long-term asset or long-term house property. Okay, so what is section 54 EC? Section 54 EC is where you sell a house property, but whatever gains you are getting or whatever amount you have received in your hand, you are investing in bonds, specified bonds like NHI bonds, REIT bonds. Okay, so these are special bonds where if you don't have to buy a new house property, but you are selling and don't want to pay any capital gain tax, you can invest in government specified bonds up to rupees 50 lakhs. So if you are having a capital gain of 50 lakh or less, you can invest that amount and you can save the entire capital gain tax. So for an investor, if you are having a tax savings, so nothing is better than that. All right, moving on to the next slide. Okay, so capital gain in case of sale of house. So I think this we have discussed in details. And if we are selling any house property, and if we are like we will talk same for the other shares and securities also. So if you are selling a house property, and you can take the benefit of indexation, we have discussed this in details. And if we have done any improvement in the house property, okay, like say for example, if we have done like any like additional furnitures and fittings if we have made, or we have changed certain interiors in the flat which has appreciated the value of the flat, that can be considered as an improvement. Okay, so any improvement, the cost of that can be added in the house property. Okay, selling of so yeah, we can consider all the brokerages and whatever other expenditure in connection to the sale of the property. We can add that as a cost, and the benefit we have already discussed in the previous slides. Like if we have any existing property which we are selling and buying a new property, then we can save the capital gain tax. Next slide, please. Okay, now I think we have discussed in details about the capital gains and its impacts, and what is the short-term and long-term capital gain. Now we are talking about the advanced tax implication. So this is very important. Most of the people who are into business, they will know this, but few other people who are mostly into employment, they will not be having an idea of an advanced tax. So what is advanced tax basically? So if you are an employee, your company will deduct the TDS every month and deposit to the government, and then you can file the ITR. If additional tax is paid, you can claim the refund. But what generally is advanced tax? So TDS is a kind of advanced tax only. But for people who are doing business, for the people who are doing trading, they are having any other type of income. And if in the entire year, the tax liability is rupees 10,000 or more, then every quarter you have to pay advance tax. So what is advance tax? You have to compute, you have to assume that whatever entire amount of earnings you are going to have in the financial year, every quarter you have to pay a certain percentage of that. So say for example, for the first quarter, you have to pay a minimum of 15% of the advance tax on the total tax liability you have in the entire year. Then for the next quarter, 45%. In the third quarter, 75%. And by 15th of March, you have to pay 100% of the advance taxes. So the due date of advance tax is 15th of the last month of the quarter. Like say, for example, if it is the first quarter, April, May, June, then 15th of June will be the first due date for the advance tax. Then 15th of September, 15th December, 15th of March, and by 31st of March, you should pay all the tax liability what you have. So you have to compute every quarter whatever tax liability you are having, so that you are not required to pay any interest over and above your taxes. So people are most of the people who miss on paying advance taxes, at the end when they are filing the return, they will see that they have some interest liability. So if you want to save this interest liability under 234B and C, then please pay your advance taxes. You can do the advance tax computation, and you can determine what is the quarterly tax you have to pay. Next slide, please. Okay, now we are quickly touching up, because I think we are running out of time. So we are quickly touching up on the budget for which is applicable to the individuals. So what all changes, what all new things have been introduced in this budget, and which will be applicable from the very next financial year, and so that we can prepare ourselves, and then we can plan our taxes accordingly. Okay, so what are we going to touch upon? Big changes in the new regime, which is applicable for individuals, HUF. What is presumptive taxation and what changes have been introduced? What is capital gain tax saving on long-term capital gain? There are some changes. Some cappings have been introduced. Is there a TDS applicable on the online gaming, and some other things also? Next slide. Okay, so what are the big changes in the new tax regime? I think we all have gone through this budget update, but just to give you a highlight of this. So only for the new regime there are changes. For the old income tax regime, there are no much changes. Okay, so from now on, the new regime will be the default regime, and the old regime will be it will be an optional regime, that if you want to stick to the old regime, then you have to choose it. Otherwise, new regime will be the default regime. For individuals who were salaried employees, they could easily shift between new and old regime, depending upon the income and tax they have to pay. So in order to save taxes, they can shift to the proper regime. But for business people, if from old regime to new regime you have already opted for, then you can only come back once. Okay, like if you are earlier you were in old regime, then you shifted to new regime. Now you can only come back once, and if you have come back to old regime, then you cannot move to new regime in future years. This is what the status is currently. Okay, so for salaried individuals and for those who are having pension, they can avail the benefit of standard deduction of 50,000. So there is no such income limit that only after certain income you can get the benefit of standard deduction. Earlier in new tax regime, there was no standard deduction. Okay, so basically, new tax regime was whatever you are earning, you pay tax on that. There was no such deductions, only one or two deductions were available. Apart from that, there was no such deductions. Now they have introduced standard deduction of 50,000. Okay, they have changed the slab rates. Earlier, for the new regime only I'm talking about, the slab rate was with every increase of 2.5 lakh of income, there was an increase of 5% of tax. Like first 2.5 lakh exempt, next 2.5 lakh 5%, next 2.5 lakh 10%, and so on. And then up to 15 lakh 25%, beyond that 30%. Now they have changed the slab rate to rupees 3 lakhs. So every slab will be of rupees 3 lakhs. So first 3 lakh, the tax is nil. Next 3 lakhs, 5%. Next 3 lakhs, 10%. Up to 15 lakh, it is 20%. Previously, it was 25%. Now it is only 20%. Beyond that, it is 30%. So this, like if you try to compute and compare the taxes applicable on the old regime and the new regime after budget, you will see that there is a good amount of tax savings in the new regime. Held, you don't have much of other investments. But since we all have certain investments, please make sure that we compare between old regime and new regime, and then only we make a decision which regime will be beneficial to us. Next slide, please. Okay, so there is a rebate. I think this is for those people who are having income well below 7 lakhs. So only those people who are having total income, net taxable income after all the deductions in the new tax regime, less than 7 lakhs, then they don't have to pay any tax. Earlier it was rupees 5 lakhs. Okay, but for old tax regime, it still remains as 5 lakhs only. So for people opting for old tax regime, there is no such addition in the like no minimum minimum taxable income. So for them it is 5 lakhs only. For the people who are opting for new regime from the next financial year, up to like if they have income up to 7 lakhs, they don't have to pay any taxes. If they have any income beyond 7 lakhs, then they have to pay the entire amount of tax applicable to them. There will be no such rebate. For those people who are having who are paying the surcharge, means they have income more than 50 lakhs. So for those people like who are having income more than 50 lakhs, they were required to pay a surcharge. So the rate was 10%. For those people having income more than 1 crore, 15%, more than 2 crores, 25%, more than 5 crore, 37%. So people who are earning higher, they had to pay higher amount of surcharge, up to 37%. But after this budget from the next financial year, it is capped to 25% only. So anyone earning like beyond 2 crore, they only have to pay a surcharge of 25%. No such limit of 37% now. Next slide. Okay, so what is a presumptive taxation scheme? Quickly understanding. So those people who are not maintaining books of accounts, or who have like a limited amount of turnover, and if they are into business or professional, then they can opt for certain benefits under under the presumptive taxation. So section 44 AD is for business and section 44 ADA is for professionals. So previously, like till this financial year, if you have business income up to rupees 2 crores, or if you have professional income up to rupees 50 lakhs, then you, and if you are doing certain type of business or profession, you are not required to maintain books of accounts. Simply you can declare that if you are a business person, 8% is my profit. If you are a professional, 50% is my profit, and you pay taxes accordingly. Okay, so and in case of business, if you are banking, like if your entire transactions are through banking channel, you can offer 6% also. After this budget, we will be having an increased limit. For business, it will be 3 crores. For professional, it will be 75 lakhs. So this is a good move, because we are seeing that most of the transactions what are happening today, it is through banking channels mostly. Okay, because cash is less involved. So for those people who are into profession, they can opt for 75 lakh of income, like up to 75 lakh of income, they can opt for this scheme of presumptive taxation, and they can pay taxes only on the 50% of the entire turnover what they have. Okay, and for business people, it is 3 crores. But there's only one condition, that your entire transaction receipts or payments, whatever it is, it should not be more than 5% in cash. So if you are having mostly more than 95% of online transactions, then you can offer these limits. Otherwise, the old existing limit will be applicable. So this is, I think it is a welcome move for everyone, because if we have like online channels, UPI transaction mostly through banks, so this limit will be helpful to us. Moving on to the next slide. So there has been introduced a capping limit on the long-term capital gains. So earlier we had discussed section 54 and 54F. So now, so see, earlier, if you were having any amount of capital gain, you could invest in a new house property and then save the taxes. So people were buying higher priced properties, okay, if they have so much of capital gains. But now it is capped to 10 crores. So if you have a capital gain of rupees 10 crore or more from selling of house property or long-term capital asset, then the additional amount beyond rupees 10 crore, you have to pay capital gain taxes. You cannot save taxes on that. So this is post budget. Those who are playing online games, so for them, up to rupees 10,000 previously, there was no tax required to be paid as a TDS. Obviously, while filing the income tax return, everything would have been going in the income from other sources. But now the aggregator or the moderator or the online gaming company who are paying you the amount, they will deduct a TDS. So there is no capping limit now. Even for rupees 5 or rupees 10, whatever you're earning through online gaming, the moderator will be deducting taxes at the rate 30%. Next slide, please. So others, okay, we will just quickly touch upon this. So basically, when you buy a property, you may take that property on loan. If you're buying a house, you are taking that house on loan. So you would take the benefit of section 24B, where up to rupees 2 lakhs, you can claim the interest payment benefit. Okay, that up to rupees 2 lakh, it would be reduced from your income. Okay, but certain people, what they should do, they should take that benefit, and while selling the property, they would add the entire interest component as the cost of improvement. They would argue that, okay, this is the additional amount I have paid just to buy the property. So this is my cost of improvement. So the government has now clarified, if you are taking the benefit of section 24B by saving rupees 2 lakhs in your income from house property, you cannot add the same amount in your cost of acquisition or improvement. So this is clarified so that you cannot take double exemption benefit. Okay. The second is market linked debentures will be classified as short-term capital asset only. So it does not matter if you're holding it for more than 36 months, but still whatever holding period it will be classified as short-term capital asset. Next slide. Okay, I think we are done here. If we have any time left, then we can pick up some questions.
So Rahul, we do have a couple of minutes left, and we do have a couple of questions as well. So one of them is very specific. It's from a senior citizen who's saying that he's booked an apartment in a cooperative housing society in 1983, for which he got a provisional allotment letter after paying a deposit. But due to some litigation, he's only got the actual possession of the site in June 2022. Okay. And he sold this flat in September 2022, and he's realized 40 lakhs out of this transaction.
Right.
Being a taxpayer in the highest income tax bracket, he wants to know the implications on his taxation for the year.
Okay, so see here we had a case study from the DDA that if the house is allotted to you, then from that period, the holding will be considered if you had paid the entire amount at the time of allotment. Okay, but income tax is of the purview that from the date of possession, whenever you have acquired the property and you have taken the possession, from that date the holding period will be computed. Like say for example, in case of the property which are under construction, so you have invested the entire amount, but only when the construction is completed, only when the possession is handed over to you, from that day we will compute the period of holding. Okay, so in this case we have several disputes going on that the income tax department is considering the period of holding from the date of possession only. So in your case, mostly it will be a short-term capital gain what the income tax has considered, and they will ask you to pay a higher amount of tax. So this is actually a dispute going on. So what they are saying is, if you have paid the entire amount at the time of allotment and you have the allotment letter, you can argue on this based on this case study. But most of the assessing officers are not approving this.
Sure, sure. There's also one other question, which is basically asking you if all other income is zero, do they still have to pay a short-term or a long-term capital gains tax on their equity mutual fund holdings?
Okay, so if you're talking only about the tax, then yes, we have to do the computation. We have to see whether if we have any capital gains as such and any tax liability is there or not. Okay, if your total income is below rupees 2.5 lakhs, if you're opting for old regime, or 3 lakhs if you're opting for new regime after budget. Okay, so then you need to compute. If that is the case, don't have to pay any tax. But since the capital gains have a special rate of tax, so you might have to file the income tax returns. So this is important for you because there's a special rate, and even in certain cases the rebate is not available. So please make sure that you just do the computation. Yes, if the income is below the taxable limit, below rupees 2.5 lakhs, then ITR is not required to be filed and tax is not required to be paid. But in other cases, you have to pay the tax.
Sure, sure. Thank you so much, Rahul. That was a brilliant presentation. I'm sure all of us have benefited out of this. Thank you for your time and for being with us today.